Hey everybody, welcome back to another beautiful day in real estate. Happy Monday. Effectively, we didn't get any agreement with Iran over the weekend in Friday. There was lots of talks. They were in there for about 12 hours, but the market didn't move nearly as much as I was going to expect it to. Again, it just kind of goes back to I believe that the headlines are becoming more and more numb to, or the market's becoming more and more numb to the headlines. Um, Again, I mean, let's start out with interest rates. Interest rates, you guys, 6.4 for the conventional, 6.39, 5.9, 5.9 for VA and FHA across the board. I mean, at this point, because they came out and said that the Strait of Hormuz is officially unusable now. The United States has blockaded it. So I would have expected a huge jump in oil prices and stuff today. And, we saw a jump this morning, but not nearly as much as I thought we were going to. We jumped all the way up to 103 this morning with a pretty significant gap. I mean, we closed at about 90, about 95, and we opened the market at about 104. So, I mean, we have about a $9 jump, which, it's close to about an 8.5%, 9% jump, right? That's a pretty big jump for oil, especially on a Monday morning. But it kind of flatlined. I mean, right away. I mean, I'm not seeing a bunch of momentum. If we look at the RSI here, I mean, we're already starting to kind of not see the momentum. Again, this isn't a trend line. It's just right now it could form one, right? I mean, it could form a nice downward trend. We'll kind of figure that out over the next couple of days. But anyhow, I mean, there we go. Not a lot of volume coming into the Monday market, which I expected to be a lot more. I mean, enough to push it up and give us a nice little gap here, but I don't know. I'm not seeing a whole lot of movement. Another thing is we saw the 10-year bond open today significantly higher and come all the way back down already. So we saw it open with a gap all the way up to 4.36, and we're back down to 4.32. So it leads me to believe, again, not a lot of momentum. I'm guessing we're going to hear some news here in the next couple days. We just don't know what that is just yet. Maybe there was something something came along that investors are seeing that we're not. And something that was pointed out to me the other day, or yesterday actually, was I was listening to a video and they were talking about how retail investors aren't buying the bond market, right? Retail investors are in stocks, they're in crypto, they're in higher risk assets because they need to, the way that they trade is a little bit different, right? We as retail traders are trading for, I shouldn't even say trading, but we're investing in the optimism of the market rather than paying attention to the market. So a lot of people, they go into a stock or a crypto thinking it's going to go all the way up here and they have no structure behind the way they invest, right? So when I think of the 10-year bond market, I'm thinking of banks and I'm thinking of like the top 1%, the billionaires. Where are they putting their money? Why are they putting their money there, right? Because if we want to be able to track them to a certain extent, right? Like you can track crypto wallets pretty well, but if we're thinking about economy and more stabilized assets, gold, silver, I mean, those aren't even that stable right now, but bonds, right? We're talking about bond markets. People are moving their money into bonds right now, because they can guarantee a 4% return, which is still beating inflation, which that's another conversation. Inflation came in significantly high at 3.3%. We're about 1.3% on average for inflation, higher than we should be. That's the goal for the Fed before they cut rates. I believe it's April 25th, April 27th. There's another Fed rate meeting with Jerome Powell. It's his last meeting as a Fed head of the Fed. And there's a possibility of them raising rates. I don't think it's going to happen. I think it's going to kind of stay flat personally. But we did see, what did we see? A 21% increase in energy and gas. So the anticipation was the Trump administration was we're going to have a swift, quick kind of blip in the market. But the conflict, since they can't come to a negotiation, is going to progress and continue to move forward. As that continues to move forward, we are now pulling data from the time that we've been in war, right? So again, we're seeing a higher inflation rate. It's not significantly high, right? It's not the 9% we saw a couple of years ago, but 3% is still pretty high. Most people don't even get a 3% raise every year, and that means that they're making less money than they did last year. You could be making $100,000 this year and then see a 3% increase in inflation, right? And then next year, you're still making $100,000 on paper, but it's only worth $97,000, right? So unless we get that inflation down, which until we see the end of this war, it's just going to keep going up, in my opinion. Maybe not significant spikes, but again, the way that they pull that data is they pull the data from they pick and choose, right? So when they say the average inflation, they're picking from different sectors. So they're not, like the most recent data came out and it said excluding energy, right? So they excluded oil and gas, very particularly, right? Because if that were the case, inflation would be significantly higher, which would be very bad for the markets, right? Markets trade based off of these numbers. But we saw a 3.3% increase. Oh, I should say 3.3% year to date inflation, which is not great. It's not terrible, but it is pushing the markets in the negative, right? So, anyhow, so next one we're going to jump into. This is kind of an interesting little topic, but who was it? Kyle Dupes, excuse me. Oil just confirmed a shift this morning. WTI 6.8% up, Brent 6.4, and heating oil 7.8. That's not just a random spike. What stands out to me is why Hormuz isn't just blocked off; it's effectively unusable right now. No clear maps of mines. Clearing takes time. Limited capacity to deal with it quickly. So basically, when they threw mines overboard Iran, they didn't have any tracking devices or anything like that. Just threw them overboard. They wanted to make sure that everything was locked up. And now, even if they wanted to open it, it's going to take days. And it says this isn't a wait a few days situation. It starts to look like a duration, and you can see it in price, not just crude, with the whole energy complex moving together. That's usually not panic. That's repricing. The markets aren't just not just reacting. They're adjusting how long this could last. So again, we're seeing pretty big moves, especially with Brent crude oil. Crude oil is a pretty big move when we see a 6%. Holy cow, Mexico's down. And you know, ask it, but that's what we need to kind of pay attention to, is a repricing of where we're at, right? So what does the market look like? I don't think we're to the end of this war. I think we have a lot more negotiating and a lot more things that are going to kind of play into effect. But anyways, we'll keep moving forward. Again, this one right here, the Kobisi letter. I watch these guys, or pay attention to these guys. They have really good data and they bring it out every day. All sorts of sectors. I'm trying to hyper focus on stuff that matters more towards real estate than anything else. But anyways, the market is numb to the headlines. We just saw the worst possible outcome for the U.S.-Iran peace talks. Not only was a deal not reached, but the U.S. itself is now set a blockade. The Strait of Hormuz military action is back in discussion. U.S. oil prices are up to $105 a barrel. Meanwhile, the S&P is down less than 0.5% today after rising 5% prior to negotiations, hopes for a peace deal. The reality is that investors are preparing for prolonged inflation and the acceleration of the AI revolution. Own assets or be left behind. So even though we didn't get positive news, the market is still factoring in that we're going to see inflation, right? And again, that's why I'm going to tell you real estate makes sense, right? Because inflation means what? Higher prices. What means higher prices? Higher prices for homes. Even if we drop interest rates, home prices are going to go up. And the reason that I'm touching on that now is because the next thing I'm going to show you, the lowest pending sales since before, the financial crisis of 2008 was the lowest pending amount of homes, pending sales index, and it's been down here for a while. But here's what nobody ever talks about, right? They say, oh, we're at the worst in history, so expect the worst. Okay, we're at the worst in history, but what happens after these markets crash? They rise, right? The market tears off again. I know it's a little different. Everyone says it's different. It's different. It's not. It's just a cycle in the economy. It's a different cycle. It's new. It's not something that can be anticipated. But what I can tell you is that history doesn't repeat itself, but it does rhyme. So things happen to create these cycles. It's not the same situation with the same outcome, but the markets go up and they go down. Right now, we're in a down market. When we're in a down market, there's a lot of sentiment is low. Like, people don't want to spend money. People aren't leaving their jobs. People are locking in because they don't see an end in sight, right? Which leads me to believe that if we are going to see a weaker economy, we need more money printed to bring in more to help the economy, right? So again, we're talking about the money supply, and the money supply continues to rise. The M2 money supply is hitting new all-time high. The U.S. is in a precautious situation. Inflationary pressures are surging, putting pressure on rate hikes. Well, the U.S. debt to GDP ratio is above 120%, indicates that rate cuts are needed. Those of you that don't know, 120%, that means that we are losing 20% more than the country's bringing in for our revenue. If any of us were at 120% GDP, or excuse me, debt to GDP or debt to ratio, you wouldn't be able to buy anything. You'd be negative. You'd be broke. You would be 100% out of money. You would be utilizing credit cards. You would be burying yourself in debt. You would be borrowing, and banks wouldn't even borrow to you anymore. If you are at 120% debt to income ratio, you are effed. You are screwed. We've been at this number for probably 5 or 6 years now, and that's why you start to see countries trying to take a precedent at being the next dominant power, because we no longer have the firepower behind us as far as the money chain goes. And that's why I start to believe we're going to see more things transition to blockchain and digital currencies, because you need a restructuring of the financial system. It just makes sense, right? All right. Anyway, so higher rates equal weaker equity housing markets, lower tax recipients, higher deficits equals more deficits need to be monetized by the Fed, higher inflation, lower rates, more credit growth, more demand for goods while supply is constrained, and higher inflation. All roads lead to inflation. And that's why Trump is pushing so hard to get inflation get interest rates dropped, because we're going to see inflation no matter which way we look. The problem is that we've been backed into this corner, and the problem that really sticks out to me is the private credit market. And the reason that it sticks out to me is because the people holding the bag for the private credit market are no longer the big banks. It is the pension and the 401k holders. These assets were created at the end of 2008 to restructure where they put money. And instead of putting banks at risk, they put your money at risk. And that's why I'm so concerned about the private credit market, because the private credit market is not looking great. And something like this popped up. The private credit market has been under fire for months, and now the smoke has reached the Fed. Redemptions keep building while funds tighten access to cash, meaning they're not letting people pull money out of these private funds, because again, we've said it before, there is no money in these funds, right? 213 billion on the books, up 31% in under a year, with Wells Fargo alone at a 71 billion. The pressure keeps building as liquidity tightens and exposure grows. So they built, and just in the last year, a lot of this was put onto the a lot of this was put back onto the banks went out. Essentially, what happened is banks loaded up on these private credits, the private credit funds. They put it all on their books. They bought them up, and now a lot of people want their money back. It's just like every other bank in the world. There is no money in the system. You don't need 90% of the money. If I deposit $100, $10 is saved and $90 is lended out to you, right? It's a 1-10 ratio. And that's how banks make money. They leverage your money on your deposits, right? That's why you're only limited to $250,000 if the bank goes under. You're not getting all your money back. Granted, not everybody has 250 grand in the account, so everybody thinks that's a high number, but honestly, it's not that big of a number. So if I had $1 million in a bank account and the bank went under and I only got $250,000 back, that means that $750,000 is no longer in existence, right? That's the problem, is that we've been in a debt-based economy for so long, and that's why the markets are so weak now, is because the chickens have come to roost in a sense, right? Banks now need liquidity, and there is no liquidity. And then not only that, but during COVID, they printed money into oblivion. So now that money all got distributed. And the FUD, like the bad part, the part that sucks the most, is everybody who got a stimulus check pushed the money right back into the economy, and it went right back into the hands of the people that don't need it, because those people earn money. That the shift of wealth between 2020 and 2022 was pretty, like, the largest we've seen in history. And it went, like, the middle class is completely obliterated at this point. Most people are working paycheck to paycheck, or they have a pretty significant amount of money lying around. Not many people are in between anymore. And it's led to consumer sentiment has never been this low. And that was my last thing I was going to touch on today. Consumer sentiment, right? So the University of Michigan consumer sentiment index fell to 47.6 in March, the lowest reading in history. The index has more than halved since 2019. So that means that consumers were extremely confident in 2019 are now the lowest confidence we've seen. Meaning, again, this correlates to people buying real estate, right? Because when people aren't confident with their jobs, they're not confident with the money they can spend, they're not confident about the future, they're not buying an asset that most of them feel like they have to be in for the next 30 years, which most people move within 4 years anyway. But most people coming in to buy homes are thinking, I'm going to be here for 5, 10, 15, 20, 30 years. And that's their intention. If that's your intention and the markets are terrible and your 401k is taking a hit, there's a war going on, interest rates are high, unaffordability is at the peak, and then on top of that, we are out there borrowing to go purchase cars on 7 and 8 year loans, and we have no money in the bank. Of course, we're not going to be buying big assets or big purchases. This comes at a current conditions index level of a record low, while Americans' expectations fell to the lowest since 1980, again, before major inflation. Meanwhile, one-year expected business conditions fell minus 20% and are now 6% below April 2025 levels. Sentiment is now even lower than the great financial crisis, as well as the great inflation and double dip recession periods of the 70s and the 80s. In fact, every major recession since the 1950s has begun with consumer sentiment higher than where it is today. Economic sentiment among U.S. consumers has collapsed. I think we're already in that recession. I think that's what we're feeling right now. And again, usually recessions, people predict them pretty significantly, but we really don't know. We really don't know exactly when we're in a recession until we're out of it. And right now, I'm going to say that we are in a recession, and a lot of people are feeling it. And that's why I started talking about this stuff, anyways, because the system has never changed, right? The system's always been like this. It's just now way more blatant and right up front. It's way more, a lot of people are expecting to see this chaos, which is causing the issues, right? People have social media, and there's a lot more people like myself that are starting to really put a light on this and say, hey, this doesn't make sense. What can we do? But I still am going to be adamant. The best time to be buying real estate is when the market feels the worst. It's the same time you should be buying stocks. It's the same time you should be buying assets. When the market feels terrible, chances are that's the best time to be buying. If you see these bigger companies, they're out here stacking up on assets. Last Friday, there was, I don't know, some billions of dollars getting pushed into the stock market because I think we're on the set of a growth period. We're not there yet. We're still figuring out the pieces. But if we hit this, like I anticipate we will, you're going to see prices of homes significantly raise. Assets are going to be higher because people are moving their money. Smart money is moving their money into assets now because this is getting close to a bottoming market in some cases. And it's very hard to say across the board everything's going to bottom because it's not. I still think the stock market's overvalued. I think that crypto is way undervalued right now. I think real estate is starting to become undervalued again. It was so overvalued for a long period of time. And in these bigger markets, New York, Florida, Texas, they had an influx of inventory, which pushes prices down significantly, right? And now you're starting to see that kind of transition because we're seeing people become more comfortable to these higher interest rates than they were a few years ago. So all of my rambling that I talked about today, I still think that 2026 is a great year to be getting into a home if you can make it work. If you can comfortably buy a home and not be eating peanut butter and jelly sandwiches every single day for dinner, I encourage you to get into that home. Because if you can get into a home and you can start generating wealth in real estate, that's where a lot of people made their money. And everybody says, well, they bought their house for $70,000 in 1990. That is not wrong. You're not incorrect. But the thing is that prices are still going up because we have continued to deteriorate the money supply. The HEM2 money supply is the highest it's ever been, which means there's more circulating money than there ever has been, which means the dollar's worth less, which means what? Your home's worth more, right? That's why assets are so powerful. But that's my tangent for today, you guys. Get into real estate. Now's the time. If you have questions, make sure to comment below. I would love to hear. And if you want me to dive into anything, if I rambled through something and it didn't make sense, I'd love the opinion. Anything else I can do to help you guys, please let me know. Otherwise, have a great week and we'll see you soon.